There's a myth that quietly costs homebuyers a fortune, and it sounds like common sense. Always grab the loan with the lowest monthly payment. It feels obviously right. It feels responsible. And for a lot of people, it's the single most expensive mistake they ever make. Today we're going to bust that myth wide open by ranking your mortgage options from the worst version of this decision to the best. So by the end, you know exactly where you should land. Picture two people buying the exact same house for the exact same price on the exact same day. One walks away on a path to real wealth. The other walks away stressed and bleeding interest for decades. The only difference between them is the number on the mortgage, 15 years versus 30. That one choice can swing well over $100,000 across a lifetime. Yet most people decide it in about 10 seconds based purely on the monthly payment. So let's slow it all the way down. First, the foundation, because it matters more than people think. Every mortgage payment splits in two. One part chips away at what you borrowed, the principal. The other part is pure rent on the money, the interest. And in the early years of any mortgage, almost every dollar you pay is interest. Hardly any touches the actual balance, so it feels like you're paying forever while the number barely budges. That's not a glitch, that's the math working exactly as designed, and it's called amortization. Fancy word, simple idea. The bank collects its interest first, and you build ownership slowly. A longer term stretches that out for years. A shorter term flips it so you own faster. Which means the length of your loan isn't just about the monthly bill, it controls how fast you truly own your home and how much total interest you hand over. Two terms, two completely different financial stories. Now, let's rank them. Start at the bottom of the ranking. The worst way most people run this decision, a 30-year loan picked purely because the payment is low, with zero plan behind it. The 30-year is the default for most buyers, and its superpower is genuinely real, a low monthly payment. Stretch the loan over 3 decades and each payment shrinks, which is the whole reason so many families can afford a home at all. But that low payment carries a brutal price tag when you sleepwalk into it. You pay interest for twice as long, so the total interest can be enormous, often more than the price of the home itself. Comfort today, a fortune handed to the bank tomorrow. As a baseline, this works. As a wealth strategy on autopilot, it's the worst seat at the table. Move up a step, because the exact same 30-year loan could become genuinely smart the moment you have a plan for the breathing room. That lower payment gives you a real cushion for a job loss or a surprise repair. And there's a sharper angle. With the smaller payment, you free up cash to invest. If your investments outpace your mortgage rate, that gap quietly builds wealth on the side. So the 30-year isn't the villain. A 30-year with no discipline behind it is. With a plan, it climbs the rankings fast. Now the move almost nobody considers, and it ranks higher than a plain 30-year for most people. Take the 30-year loan, then voluntarily pay it like a 15. Add extra to the principal each month whenever you can, and you shrink the timeline yourself on your own terms. This hands you the safety of the lower required payment plus the option to crush the loan early. In a tight month, you pay the minimum. In a good month, you throw extra at the principal and watch the balance drop. Just one rule, tell your lender, or note it clearly, that extra payments go toward principal, not toward next month's bill, and confirm there's no prepayment penalty. Most modern mortgages don't have one, but always check before you assume. And don't underestimate small amounts. An extra $100 or $200 a month, applied early, can knock years off a 30-year loan and save tens of thousands in interest because early dollars carry the most power. And at the top of the ranking, the best fit for the right person, the 15-year mortgage. The payment is higher, no sugarcoating it. But in exchange, you get two powerful gifts, a lower interest rate and far less total interest paid because the bank rewards you for taking on a shorter, less risky loan. Lenders typically offer 15-year loans at a noticeably lower rate, often around 0.5% lower as a rule of thumb, though it varies. Combine that lower rate with fewer years and the savings get dramatic. You own your home outright in 15 years instead of 30, so picture being completely mortgage-free in your 40s or 50s with no housing payment at all, that freed-up cash flow supercharging retirement, travel, or simple peace of mind. The 15-year also builds equity fast, since from day one, a bigger chunk of every payment attacks the principal, growing your ownership stake quickly, which is a real safety net if home prices wobble or you need to borrow against it. Let me make the gap concrete with a simple example. Say you borrow $300,000. These are illustrative numbers, not a quote, but they show the pattern clearly. On a 30-year loan at a typical rate, your monthly payment for principal and interest might land near $2,000. Affordable, manageable, easy to say yes to. But write it the full term, and the total interest is staggering. Over those 30 years, you could pay well over $300,000 in interest alone. Read that again. You might hand the bank more in interest than the entire price of the house. Now the 15-year on the same loan at a lower rate, the payment jumps, maybe to around $2,300 a month. Higher, yes, but the total interest shrinks to a fraction of the 30-year, roughly a third, sometimes even less. The difference between the two paths can easily top $100,000. That's a paid-off car, a college fund, or years of retirement lost to the longer term. So the trade is clear. The 30-year buys you a smaller payment and flexibility. The 15-year buys you a lower rate, faster freedom, and massive interest savings. Neither is wrong. The right one depends entirely on you. So don't start with the term, start with your life. Is your income steady and reliable, or does it swing? If it's rock solid and comfortably covers the higher payment, the 15-year shines. If money is tight or unpredictable, the 30 years flexibility may protect you better. Do you have a solid emergency fund? Locking into a high payment with no savings buffer is risky, so build 3 to 6 months of expenses first, then a 15-year becomes far safer. Safety net before speed. Are you a disciplined investor, or be honest, a spender? The 30-year only wins if you truly invest the difference every month for decades. If that cash quietly vanishes into lifestyle, the 15-year forces the wealth building for you. And how close are you to retirement? Carrying a big mortgage into your 60s can strain a fixed income, so if you want to retire payment-free, a 15-year or paying a 30-year off early can be a powerful plan. Before you decide, dodge the traps that quietly drain people. The first is shopping only by monthly payment, because the cheapest payment often hides the most expensive loan, so always ask about the rate, the term, and the total interest. The second is stretching to a 15-year you can't truly afford, because if the higher payment leaves you one bad month from missing it, you've traded one risk for a worse one, and the safer term you can sustain beats the aggressive one you can't. The third is assuming you'll invest the difference and then not doing it, so be ruthlessly honest, because if the spare cash from a 30-year won't actually get invested, the 15-year is almost certainly the smarter, wealthier choice. And the fourth is forgetting the full cost of owning, since taxes, insurance, repairs, and maintenance all stack on top of principal and interest, so leave room for them, because a payment that looks perfect on paper can squeeze you once real life arrives. So, let me hand you a small challenge this week, and I want you to actually report back. First, pull up a free mortgage calculator online, plug in your loan amount, and compare the 15 and 30-year payments and total interest side by side, because seeing your real numbers changes everything. Then check your budget honestly. Could you cover the 15-year payment and still sleep at night, even in a rough month? If yes, lean 15. If it stretches you thin, choose 30 and commit to extra payments instead. And whatever term you pick, set up one small automatic extra principal payment, even $50, automate it so you never feel it, and let time and math quietly work in your favor for years. Carry this mindset with you. There's no universally correct answer, only the right answer for your situation. The 30-year and the 15-year are just tools, and your income, your discipline, and your goals decide which one fits your hands. The 30-year means lower payments and flexibility, but far more total interest. The 15-year means higher payments, a lower rate, faster freedom, and big savings. And anyone can split the difference with extra principal on a 30-year loan. So run that calculator tonight, then come tell me in the comments which way you're leaning and the actual number it spat out. Are you team 15-year chasing the savings or team 30-year protecting your flexibility? I want to see your real figures, so report back. If this finally made the choice clear, hit like so, it reaches the next person at the closing table. Send it to someone you know who's house hunting right now, and subscribe so the next big money decision feels this simple too.